Good morning, everyone. Well, it happened just like I said it would. The FOMC decided to begin tapering off its bond purchases at yesterday's meeting. Treasury yields moved a little bit higher, but the implied rate on the 2016 Fed funds futures actually fell by 1 to 2.5 basis points because the FOMC included a new sentence in the statement that said it likely will be appropriate to maintain the current target range for the Fed funds rate well past the time that the unemployment rate declines below 6.5%. In other words, the Fed balanced the tapering off of its bond purchases by extending its forward guidance. Fed funds expectations are now below where they were even before all the tapering talk began back in May, at least out to end 2015. This demonstrates the success of the Fed's forward guidance in keeping rate expectations separate from tapering expectations. From now, I think we're in exactly the same situation as Britain is. Investors will be watching the strength of the economy, particularly the labor market, to gauge if the Fed is likely to bring forward the time when it begins to tighten. This is exactly what's been happening with Britain and the Bank of England's forward guidance. And I'd expect to see a similar result with the U.S. and the dollar. As the U.S. economy continues to improve, I assume, the market will adjust its estimate of the timing of the Fed's move and the dollar will rally, much like the pound has been rallying as unemployment there falls more rapidly than expected and rate expectations shift. Now, after the tapering, the dollar soared against most currencies, with the largest gains over the last 24 hours being against the Swiss franc. I think that's significant. The Swissy was the biggest loser during yesterday's European morning trading too, which was rather difficult to explain as the Credit Suisse ZEW survey registered a pretty good gain. The rise in dollar Swissy, along with dollar yen, suggests to me that carry trade funding is moving decisively out of the dollar and into other currencies. Plus, the last vestiges of the anti-inflation hedges are being dismantled. Gold and silver were also down sharply. I think this marks the start of the dollar rally that many commentators have been predicting for 2014. Today, we've got UK retail sales for November. Excluding auto sales, these are expected to be higher. That would signal a continuation of the consumption-led expansion in Britain and probably add further fuel to the sterling rally. In the U.S., initial jobless claims for the latest week are expected to fall to 335,000 from 368,000. That would bring the 4-week moving average to 335,000, which is basically in line with the previous 331 and probably have no impact on the dollar. On the other hand, the December Philly Fed survey is expected to improve to 10 from 6.5. I think that would add to the bullish dollar sentiment. Countering that might be the existing home sales for November. They're seen falling slightly to a 5.02 million annual pace versus 5.12 million in October, but that's probably not enough to disrupt expectations of continued tapering and change anybody's view. For more information, including technical analysis, please read the full comment on IronFX.com. You can also follow us on Twitter, like us on Facebook, subscribe to our YouTube channel, or circle us on Google+ to get more trading ideas. This is Marshall Gittler, head of Global FX Strategy at IronFX, wishing you solid trading.